We'll get to it. All right, so let's begin. This is me, I'm your presenter. I'm AJ Ayers. I've got a bunch of designations. I'm one of the co-founders here at Brooklyn FI, and I'm presenting today. I've helped folks through many IPOs, many direct listings, many SPACs. This is what we do here at Brooklyn FI. It's most of what we do. About 75% of our clients have equity at either a private or public company, and our specialty is helping through that transition. So today we are here to look at an S1, which is a form that is filed by a company when they are ready to go public. It is the initial step, the toe in the water towards potentially becoming a public company listed on one of the exchanges. Typically, that's going to be the New York Stock Exchange or the NASDAQ. And what we'll find in the S1 as we go into it is there's lots of tasty morsels of information about your company, about the people that work there, about how much money they make, how much money they stand to make through this public offering. But there's also some, I love these. I love reading these documents. To me, they're stories. It's the story of a company. It's a company's chance to convince investors that it's a good idea to buy shares of this company. IPOs are typically, they're very complicated transactions. There's a lot of lawyers and financial professionals that go into these transactions, both within the company and then externally. So we're not going to meet all of those people today, but we'll talk a little bit about all the roles all the people that make this possible. Before we get started, drop your questions for the panelists. That's just me today, the panelist. In the chat box, I'll try to answer those as they come up. A few of you did submit questions ahead of time. I've also got some BKFI team members in this room as well to hop in as needed. And of course, we'll post a recording of this webinar to our events page, which I just put in the chat within a few days. Okay, so let's get into it. Let's talk about our agenda. And we're going to first talk about the life cycle of the startup, what you can learn from an S1. We will meet EDGAR, which we'll learn who that is in a moment. And then we're going to do a deep dive into a specific company's S1. I have chosen Chobani, the yogurt company. They filed their S1 back in November. So we don't know when they're going to go public, but that was a pretty big signal to the market that they're gearing up and ready to go public. We'll talk about dividends. We'll talk about employee ownership, 401k match, financials, highest paid executives, a bunch of things that you can find within this S1, and then I'll take questions from you, of course. So let's start with the life cycle of a startup. So this, I love this graphic. I've seen this. This is like the Wikipedia Commons graphic. We should probably have our graphic designer whip up a nicer version of this, but it's very helpful. It shows us in very clear language or clear visual, what is the life cycle of a company. So a company gets founded. This is called the Valley of Death, when they're definitely not profitable. And this is really when we get seed capital. Potentially we get some angel investments. Does anyone know what FFF stands for? I'll give everyone a second to potentially drop that in the chat. I always find this funny. Okay, not getting any responses. It stands for family, friends, and fools, or friends, family, and fools. So this is, you're commonly referred to as like a friends and family round. Occasionally fools, folks who early on are going to give you some money based on an idea or based on a concept, based on a pitch deck. We don't have profitability yet. Maybe we don't even have a product. We just need money to get going. That's our seed round. Then we have our early stage. Usually that's, maybe some VC money. That's going to be our seed round, another seed round, maybe our Series A. Then we get to our later stage, potentially, B, C, D, E, F. We could go all the way. And usually by the time we get about a quarter of the way through the alphabet, that's when we talk about a public offering of some kind, or potentially an acquisition. That's another way to go. And this part here is really where we're filing the S1. That's where we're ready to go public. We have a path to show our potential investors of how we potentially will become profitable in the future. And then we become a public company. But what's really cool is, we can basically predict what type of equity compensation is going to be granted at each level. It's not perfect, but I've been doing this a long time, seen a lot of equity plans. I'm pretty sure that I can tell you, if you've got an early stage company and you're about to raise Series A, employees are probably still getting incentive stock options or ISOs. Before that, when we're in this stage, there's usually just founders stock. Maybe, the third employee is getting some restricted stock, and maybe they're going to get the first ISO grant. As we start to move later, we have more money, we can maybe hire an accounting team. Maybe there's non-qualified options that start to get issued. And then typically, once there's a public offering, company's public, usually we see mostly RSUs granted. Sometimes we'll see non-quals, and very rarely we will see incentive stock options continue to be granted after the company is public. So that's the life cycle of a startup. I just always like to start there because I just love this image. All right, question. So what parts of the S1 are relevant to you as an employee? The S1 is filled with lots of financial data, which we are not going to dive that deep into because that's really not for you as the employee. As the employee, you are concerned about how much equity you have. What lockup restrictions will you have? Will you have access to an ESPP plan, which we'll define later? How much of the company is allocated to the employee share pool? Who of your senior leadership, what does their compensation look like? You've always known that the CEO gets paid a lot of money. Well, this is your chance to actually know exactly how much they are compensated each year and how much they plan to be compensated through this IPO. It is now public information because they have lifted up the veil and said, here we are, we're ready to go public. Here is all of our dirty laundry. Typically leading up to an S1, firms or new CFOs are basically brought on to clean up the dirty laundry and get the company ready to go public, get them ready to file an S1. A company could be working on writing the S1 and gathering all the data for the S1 for years, right? Some companies are prepared to do it from day one. That's their goal. They want to be public in 5 years. Other companies would have never even dreamed that they'd be public. So they have some cleaning up to do and some getting all their ducks in a row. Will there be a lockup period? That's in my opinion, that's one of the most important things that we can get from an S1. Is there going to be a lockup period? And then asterisk, is there going to be an exception to that lockup period? And I'll show you how to find that as we go through the presentation. Okay, so here's EDGAR. I told you we'd meet him. EDGAR is the electronic data gathering, analysis, and retrieval system found on the SEC website. So you are going to use EDGAR to search for your company's S1 when it is filed. There is not a great notification system, unfortunately, for this. I honestly recommend a Google alert for if you're working at a company and you're wondering when things are going to happen. Your company will not always let you know that they have filed their S1. Typically, these filings sometimes can be confidential, which means that they will let everybody know that they've filed an S1, but it actually will not be publicly available in this EDGAR system. So that may happen. That's unfortunate. I've got a little GIF of how to actually do the search. If you just Google EDGAR search, you will get here to that. And you can look up any company who's ever gone public, who's ever filed an S1. You can actually go back historically and look at them. If you're a nerd like me, it's pretty cool to see, what does Facebook's, or I'm sorry, Meta's S1 look like? We can actually go back and look at it. This is what it looks like. It's a really, really boring, ugly HTML web page. There's a way that you can print it. It's very difficult to navigate. It's very difficult to scroll. It takes forever to load. Typically, these S1s are 200 or 300 page documents with all of their appendices. So that's what it looks like. And so what's in it? This is the table of contents. We've got general information, prospectus, risk factors. A lot of this is related to finance. A lot of it is related to disclosures. A lot of times you will be presented with a financial statement, and then it'll be followed by pages and pages of disclosures, justifications, things like that. My favorite part of an S1 is really the summary. That's really where we get to know the company. It's kind of their chance to say, like, this is who we are. This is why you should invest in us. The use of proceeds is also a fantastic place as an employee that I would find very intriguing, which is, let's say you work in the marketing department and part of the use of proceeds is, $1 billion investment in expanding marketing. Well, that's exciting to me if I know that there's a big investment in my department coming up. Honestly, if you're taking notes on this presentation, the biggest thing I can say is, as you're looking through this document, you're going to be using Control Find, Control F this whole time. So use of proceeds is a really fun section to go into. Not going to go through all of these today. We would be here for 4 hours. So typically the S1 opens with a letter from the CEO or a letter from the founder. And I like to call this the TED Talk, because this is kind of the high level, this is why I started this company. This is why it means so much. We're changing the world. Here's our mission statement. Chobani is the story of a few dedicated everyday people coming together to create something extraordinary. Now, we could probably replace Chobani with any company, right? It's a lovely thought, and I agree with them. I love their yogurts, to be honest. But it doesn't really tell us much about the company. So you'll find that these kind of opening statements are a little woo-woo, they're a little over the top, and we are changing the world. We are doing well by doing good. There's a professor at NYU, specialist in marketing, who has a podcast. His name is Scott Galloway. And he calls some of these like opening statements yoga babble, because it's just like, what are you talking about? But look, it's a great chance to get to know the CEO. From my upbringing in Turkey, when I knew that high quality food did not have to be a luxury and only available to the well-off, like you're getting to know this company. And remember, the purpose of this S1 is to get people to invest in this company, right? That's really the purpose. You're going to get all of this information about where they're trying to go. I found this interesting, that there's an anti-CEO playbook, which inspires new ways of doing business. You'll find that a lot of the language in the S1 is basically an apology for why they're not as profitable as they should be. So it's like, why aren't we this profitable? Well, it's because we've invested in our communities, and we believe that business done right has the ability to change lives and strengthen communities. It's a new way of doing business, prioritizing people. Like, okay, so we've invested a lot more. It's going to be more expensive to do business the right way. So maybe that's why we're slower to profitability. Whereas if we had prioritized profits over people, our balance sheet would look very different. A lot of it's just like, I know the numbers don't look the way that you want them to, but here's why. And here's why, in the future, if you invest now, you're going to see great returns on your investment, 10, 15, 20 years down the road. What else do we have? So now I'm just going to kind of like shout out things that I found interesting. I thought that was kind of the best way to do this, because otherwise it'd be really boring to go through it page by page. So they're not going to pay dividends. So dividends are when a company is public, the stock is trading. When that company has cash, typically they will distribute that to its shareholders. So there's no pressure really there is pressure to increase the stock price, because if you're a shareholder, you're not getting those dividends. You may hear about, your grandparents talking about their high dividend paying stocks. They want steady companies. They don't necessarily need to see incredible growth in the stocks that they own. They just want to see steady cash flow and quarterly dividends, that get paid to them. Chobani is said they're not going to offer dividends. A lot of high growth companies don't pay dividends. Amazon, Boeing, Facebook, Meta, if you used to call it Meta, Google, Tesla. These are stocks that we see, they're very volatile. They've produced fantastic returns for their investors, but they don't pay dividends. So that's just an interesting factor to kind of understand when you're thinking about that as a shareholder. A company like Microsoft, always pays dividends. So as your RSUs vest, you will start to earn income, which is great. But the downside is that there's no surprise taxable income. If you're a large shareholder, you may be surprised to find that your tax document at the end of the year says you got $10,000 of taxable dividends. Didn't know that was coming. If they're not paying dividends, they're investing that cash back into the business. That's the idea there. So there's when we don't pay dividends, there's no cash flow to the shareholders. So if those shareholders are expecting that, there may be a stock buyback program, which means there will be an opportunity to sell the stock back to the company in order to generate some cash flow for some of the larger shareholders. I'm going to stop there because I've kind of been babbling. Does anyone have any questions so far? Anything about S1s or anything that I've covered? I imagine you're just waiting for how much are the CEOs paid. Yep. Okay, cool. Okay, so here we are. Get to know your NEOs. So these are our named executive officers. These are typically the folks in leadership at the company. So that this is now public information. I guess this was public before. You could probably find it on LinkedIn, but it was never quite organized like this for investors or really, employees to look at. When you're a private company, you can do whatever you want. You don't have to disclose much. Now that you're filing to go public, like I said, that dirty laundry, we have to show everything. We have to show the org chart. We have to show how much everybody owes. Now, what's interesting is that, so here we have all these named people. So in the S1, you'll actually get to read the bios of all these people and figure out who they are. But in this financial table here, it's blank, right? It doesn't say. So before the offering, we would know how many shares they have of Class A and Class B shares, which we'll talk about in a second. How much voting power does this person have? Does the CEO own 60% of the company? That's good to know as an investor or as an employee. But it's blank because this is an initial filing. We don't have this information yet, which can be kind of frustrating when we're looking at an early version of this S1. So some deets here. We're looking at what's her name? Jody Macedonio. I just picked her out because I liked her name. So we get her whole bio. She has served as the CFO since December of 2020. So remember what I said earlier about they typically, we see these companies bring in like a ringer CFO, someone who's taken another company public, kind of like a year or two out from that IPO. So she was at Dean Foods, a dairy company. So that definitely seems like a great fit for Chobani to hire someone who's already worked at a very large, I don't know if Dean Foods is public, but company in the same industry and sector. I always find this interesting, family relationships part. That's a disclosure that has to be made. Like, did the CEO hire their entire family to be the executive team? That's an interesting disclosure that I would want to know as an employee. Sometimes you find out that, oh, I had no idea that the CTO was the CEO's cousin or sister or something like that. I just love, honestly, the S1 is just like gossip. There's a lot of good financial information in here, but it's also just a lot of, ooh, I didn't know that about that person. So randomly, this is kind of cool. In the S1, you can actually find out what the 401k match is. That needs to be disclosed to investors. That's going to be a line item on the balance sheet for the company. So we actually can see that match outlined. So pro tip, if you're interviewing at other places and you know that it's a public company or a potential company that's maybe about to go public, you can actually go into the S1. Remember that Control F for 401k, and actually you can find out if the company offers a match. I think that's cool. ESPP plans, in-store employee stock purchase plans. This is an employee benefit where employees can typically purchase a certain amount of the company stock once it's public at a slight discount. So typically we see ESPP plans be made available to employees either right after the IPO or once the lockup ends, usually about 6 months in. And you might be able to use, let's see what this says. So the maximum is that 10% of your total compensation can be used to purchase shares of Chobani at a discount. Let's see. Discount. Oh, is expected to be 85% of the fair market value. So you get actually a 15% discount on Chobani stock. Typically, Brooklyn FI is a big fan of ESPPs. The S1 will tell us if the company is going to implement one or not. Cool, then we get to the P&L. This is where we dig into the finances a little bit. For those folks who do not have a math background, these P&Ls can be very confusing because they are actually listed in thousands. So here, even though this looks like it's $1.2 million, it's actually $1.2 billion. So I find that to be a bit confusing for some of our clients who don't necessarily have a background in finance. And what's also interesting about financials in S1s is that they won't, the financial year might not be over, but they want to show that this current year was a banger year, that they're showing growth. So even though the financials aren't done for the whole year, they want to compare this year to what happened last year. So you'll see here, they're looking at a 9-month period that ended, end of September. Basically, that's the close of Q3. So they basically wanted to show investors that, look, we grew significantly year over year. Of course, now it's February, so I would expect that in the next updated S1 that we get from Chobani, we would have audited financials from 2021 to show here. And maybe even Q1, maybe they've been waiting for the financial results of Q1 to actually go through with the filing. What else? Yeah, so they maintain growth. We do see some nice growth happening year over year. So, not quite explosive growth like we see with some of our software companies. This is a food product company, remember, but good numbers here to analyze. Cool. I'm going to introduce the concept of EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. This is my favorite financial tweet of all time, which is EBITDA for millennials, earnings before interest, taxes, drugs, and alcohol, which I think is very funny. But EBITDA is a financial metric basically used to evaluate how a company is doing. So that's going down. Not great there. So that's a good indicator to see, what does the financial future hold for a company like Chobani. What else do we have? Oh, like I said, the S1 is full of funny things. So remember, this is a fucking yogurt company, right? So the what is going to impact Chobani's ability to be profitable? Well, if the price of milk goes up, it looks like they only have one supplier. They have 70% of all of their raw milk comes from one supplier, Dairy Farmers of America. So what happens if DFA has a bad quarter, or what if there's an outbreak amongst their cows? Because Chobani is such a big player in this space, they've got 20% market share right now. There's only so much milk to go around. What if Dannon comes around and offers DFA a much better price, and that sinks Chobani's margin? It's just funny to think about all of the threats to a company, and they're really all listed out in the S1. Okay, cool. Now we get to one of the most important things for you as an employee when your company is potentially about to go public, is the lockup, which means that if you are a shareholder, director, officer, current and former employees, and holder of any securities, you will typically be subject to a lockup period, meaning, and the reason these exist, because we don't want the company to go public. Finally, everyone has some liquidity, everyone wants to get their money out at the same time. All the employees, all the shareholders sell at the same time, and then the stock price tanks, right? That's a classic supply and demand. So typically we see lockup periods of 180 days. This is very common, pretty standard across all companies going public. But there is typically, not typically, we start to see this a little bit more. We saw this a lot more in 2021 than we had in the past. This concept of early release terms, which is like, yes, there's a lockup period, except there's a little loophole that for a few days, just at the IPO, employees, key shareholders, officers will be able to sell some of their stock. So there's a lockup period, but there's an asterisk. And so this early release term here says that most employees, most rank and file employees can sell up to 40% of their vested shares on the second day of trading. That's pretty good, right? So if you're an employee, or maybe even a former employee, and you have some shares, you can sell up to 40% of what you have right at the IPO. Not right at the IPO, the next day after it. And that percentage is dampened a little bit. It's only 30% for officers, those NEOs that we saw on that list earlier. So this is great information. So as a financial planner, this is the information that I'm always after when I'm building trading plans for our clients. It's like, we want you to sell as much as we can out the gate. Oh, but we can actually only sell 40%. Then we have to wait till those 180 days have passed until we can trade freely within our trading windows, of course. Other stuff that I found in here, the founder owns a controlling interest in a coffee company and a feta cheese company. If you're a coffee nerd like I am, La Colombe, delicious coffee, makes sense. Again, the S1 is just all about disclosures. They want to, there's no stone unturned here. There's lots of legal professionals and financial professionals, like I said, who go digging, interviews the CEO for hours. Is there anything that we need to disclose to investors? Any conflicts of interest, interest in other companies, of course. So that I just found very, very cool. Then there's this concept of our Class A shares versus our Class B shares. So typically Class A shares are the more common ones. These are the shares that are going to be sold in the open market. And then we have these B shares, which are typically reserved for those highly compensated executives and NEOs. But what's interesting is, again, in our S1, a lot of this is blank. A lot of these numbers are blank. The IPO hasn't been priced. They're not quite sure what the share pool is going to be. They've given some grants of these Class B shares, but they're not quite ready to disclose it. Actually, in this S1, maybe we'll do another webinar on the financials. In this S1, there's quite a complicated financial restructuring that takes about 16 pages of text and diagrams to explain. So that's what this slide is showing. But yeah, these numbers are blank, so we don't really know what's going on here. Then we get to our compensation disclosure. So this is what everyone makes. This is what our highly compensated, our NEOs salaries are. So you can know what your boss's salary is in case you were curious. And then there's also an incentive plan. So you can also know what their bonus is going to be. So if they hit that incentive, looks like the CEO gets 100% of their base salary. So he'll be taking base salary of $3 million. That's pretty cool. These are in millions, by the way. These are not in thousands. I always find it difficult to keep my numbers straight when reading an S1 because they jump around. The financial statements are all in thousands. A lot of the regular numbers are just regular numbers at that. And then we've got some of these other folks getting 50% of their annual bonus. 50% of their annual compensation as a bonus. If they hit these key business and financial metrics. So, that's good to know. They're incentivized to grow the company and make it profitable and do well by their employees, as they say in their mission statement. Let's see, blah, blah, blah. So finally we get some disclosures. Now we get some numbers. So there's these very special pre-IPO Class B units. So the CEO did not get any incentive awards during 2020. And then, so we're going to go through the 2020 plan, and there's a 2021 plan. So essentially, the companies like this, when they get to a certain size, when they get to a certain stature and are preparing to go public, they're going to need to attract top-level talent, very experienced talent who know how to run big companies like this, know how to take companies like this public. So I believe, I might have to do some research or go back to my notes, but I believe that these 4 people are actually newish hires, right? They had not been with the company from the beginning. They were kind of brought on later to kind of level up the company or grow it up, if you will. So they have been compensated with some pre-IPO Class B units. Remember, those Class B ones hold 10 votes, 10 shareholder votes as opposed to 1 shareholder vote. What else do we have here? Yeah, so you can kind of see like, wow, this Peter McGinnis guy, it looks like he's fairly well compensated in terms of taking this company public. Cool. Another thing that I found interesting is that they've achieved a positive operating cash flow in every year since 2015 and reported 106 million in 2020, up 33% year over year. Healthy operating cash flow enables us to make strategic investments in our business to drive future growth. Let's remember, folks, that operating cash flow does not mean profit. We typically see companies going public that run significant losses. We don't need to be profitable to go public, but having $1 million in operating cash flow is quite an achievement for a company like this. They've taken on some serious investment. An IPO is really that chance to get a lot of cash quickly to continue to grow the business, to really change the business, take it to the next level. Cool. Now we get to the fun part. So that was Chobani. That was our deep dive on Chobani. I just want to switch gears because this is just such a great classic example of an S1 to WeWork. So I'm sure some of you are familiar of the WeWork going public catastrophe. This was in September of 2019. The WeWork S1, I encourage you to look it up on EDGAR. It can be a fun exercise, is filled with pages and pages of images and presentations and a lot of, honestly, frankly, nonsense. We dedicate this to the energy of we, greater than any of us, but inside each of us. This is a screenshot from the S1. This is the financial document that's filed with the SEC that's designed to entice investors. So I just thought that was funny. And now that you've seen one of these balance sheets, so here is WeWork's, I'm sorry, their P&L from September of 2019. So we can see that they're running basically a $1.6 billion loss in 2018. That's the company filing to go public. So obviously there were some pretty big red flags there. And WeWork did not successfully go public in 2019. They restructured, reorganized, completely changed the business, and actually did go public. They made their public debut this past October, I believe, via a SPAC. So a special purpose acquisition company. They merged with another company that was already public to provide some liquidity for the employees who didn't get that liquidity the first time at the public offering. And that is the end of my presentation. I had some questions that were submitted ahead of time that I will answer now, and I can also take any new questions. I know that was a lot, and I kind of talked very fast, but hopefully you got a good preview as to like what's actually in this document. So how far out from IPO do employees usually find out? This is a tricky one because of all the secrecy and like cloak and dagger like that is required legally in the filing of an S1. It really depends. A lot of our clients are shocked to find out that their company is filing to go public, and it's a surprise. So sometimes it could be, honestly, it could be a few weeks I would say at the shortest. Typically, you have a bit more warning. Like I said, a great warning sign is if your company brings on a new CFO. Typically, the press release will have something around, there'll be language like, and so-and-so was brought on as our new CEO, and they've had success taking these 6 companies public before, and is going to assist us in our, charge forward. Typically, I would say you usually have about 3 to 6 months when there's a serious plan for an IPO. I don't have data on S1 filing to actual public offering in times of when the markets are frothy and happy like they have been for basically the past 10 years until this world war that we're in. IPOs could happen very quickly. We could see an S1 filed on March 1st, and we could have the company public by the end of the month. What we're seeing right now, Chobani is a great example, filed in November. That's the initial statement that they want to go public. It's taken a few months. We don't know when they're actually going to get it together to go public. It could be any day now, or it could be 6 months from now. We actually had a company, or not we, but there's that company JustWorks that does that's a big HR in the HR space. They filed their S1. They were on a very quick timeline, and then they pulled back their IPO because they didn't like how the general stock market was looking. They didn't want to go public in a period of volatility in a slight downturn that we're in right now. And then someone said, how can I sell my shares at the IPO price? It's a great question. It's really going to be dependent on the lockup, and if you have that exception to the lockup, that early release provision. Typically, we have another webinar that we did a year ago called how to prepare for an IPO, and we really get into like the ins and outs of like, how do you transfer your shares? How are you actually able to sell? My best advice for you is to make sure that you reach out to the finance team and you're very clear on how to do that. Typically, it involves setting up a relationship with the brokerage firm that the company has chosen. So typically, the company will choose Schwab, E-Trade, or Morgan Stanley. Morgan Stanley owns E-Trade, so really Morgan Stanley. Which brokerage firm are your shares going to live at? Establish a relationship there, have a login so you're ready to go on day one to hit that sell button. And that is all that I have for you today. I will do one last call for questions. We have a shy group today. That's okay. I did see that all of you stuck out through this whole webinar. I did not see our participant count dwindle, which is very exciting, which hopefully means you found it useful. So thank you so much for listening. I hope I would encourage you all to hit up EDGAR and find a company that you're interested in and actually read their S1. I think some going back in time, the Etsy S1 is fascinating. WeWork S1, Facebook S1. And yeah, try out the Chobani S1 and eat your yogurt and live long. Thanks so much for attending, and we'll see you all soon in another webinar. Bye.